Hi, everybody. Welcome to this session of CFO Connect. This webinar is hosted by CFO Connect, the private community of more than 12,000 finance leaders. I'm really happy to be here today with our guests, Alexander and Philip, to talk about how CFOs can build Europe's first trillion-dollar company. Let me introduce myself. I am Raluca Ragab. I'm a partner with Eurazeo Growth, which is a later stage investment fund. I'm based in London, and I've invested in a lot of enterprise software businesses or e-commerce enablement businesses. I'm here with two guests. Philip is actually one of our portfolio company CFOs, and then Alex is CFO of one of the funds that we respect the most in Germany and London, Cherry Ventures. I will let you each introduce yourselves. Maybe we start with Alex.
Awesome. Yeah. Thanks, Raluca, for the kind words and happy to be here. Thanks for the invitation. I'm Alex, CFO and partner at Cherry. Joined around a decade ago now. And my prior career, I spent in investment banking, mostly with Morgan Stanley. Did various things there, but I would say the most exciting part was helping companies IPO. I had a front row seat in what great companies and potential trillion-dollar companies look like at that time. And at Cherry specifically, I wear a few hats. I lead our fundraising and firm operations. I oversee our funds and day-to-day management. I lead our value creation team, so that we call strategic resources. So that's a specialist group of people that work with our companies once we invest across various functions, recruiting, corporate finance, branding, communication, and anything else that founders like to throw at us.
Thanks for having me. My name is Philip. I'm the CFO of Cognigy. We are a Series C company, 30 million CRR, 150 employees. In the space of conversational AI, we have pretty high valuations, but we are not at 1 trillion so far, but we're trying to get there. Before I did that, I joined another company as a CFO, Connect also a SaaS and professional service company as a CFO, which we sold 3 years later to the biggest media company in Germany. After that, I took over the position as a CEO. What is the role for CFO to scale those companies to a trillion valuation? It's important that you know what are the needs of a CFO, and that you have to deliver from a CFO to your boss and to the founders. And before I did that, I joined M&A companies. So we supported some major deals in Germany, Holiday Check, Elite Partner, Online Shop, to get sold to strategic investors, but still not for a trillion, but let's say to a billion valuation. And before that, I worked for big corporates like AOL, Bertelsmann, and Commerzbank. And yes, I started my career in 99 in the digital space. So it's pretty few colleagues of mine that started that early. So I know what it means to have these boom, the 2000s and 2001, and also the crash. So I survived until now. And I can say from my experience, it's pretty hard to get a trillion valuation, but I would say don't give up. And I would say it's possible.
Fantastic. Well, today we're going to talk a little philosophically about it, and then we're going to hopefully hear from you some concrete and actionable things, how CFOs can really make this happen and help make this happen. Now, I think that we have 29 of you right now dialed in. Thank you very much for joining. Feel free to use the chat or the Q&A tab to ask questions. We will proceed with the discussion, but then I'm going to leave ample time at the end for Q&A. So I'm going to be going through your questions. Feel free to shoot them at any point in time. There is a quick poll for you to answer now. Do you think a European company can ever reach $1 trillion valuation? I'm going to go ahead and click mine. Host and the panelists cannot vote. There we go. Go ahead and click, and then we're going to let you know the result. I think we're good. Alex, this idea started with the fact that you went publicly out there and put out not just a statement, not just a view. Oh, there we go. We have the answers. And now 61% of you believe it. Now let's make it happen. Back to you've gone out, and Cherry has put out a manifesto on their firm belief on this ability to build such a European, super champion. Walk us a little bit on why you believe in it, what led you to that conviction, and anything we can take away from it. Let's start with that.
Yeah, sure. Happy to do that. Maybe taking a step back, because I didn't mention it in the intro. but for everyone who doesn't know, so we're an early stage firm. Think of us as the earliest capital to a business. We are investing across Europe and have been true to that since our start. And obviously, we see ourselves in a special position to play a role in helping companies get there. We invest at the beginning. We like to partner with founders from day one. And we've just raised $500 million in funds to double down on this belief that Europe can and is ready to build global and generational companies. We think the moment is now because there is a very high degree of great talent in Europe, especially the technical talent. If you see the growth rate at which the talent pool actually grew over time, has been outpacing the one of the US. And there's just also a much higher founder mindset across people, coupled with a lot of deep tech expertise that Europe is particularly strong at. And we have this talent here, and an ecosystem that has reached maturity when it comes to funding. If you look at the time that we've started in, you're able to raise lots of money across stages now. Obviously, it's not, we know where the gaps there are still, but at the same time, those are the important ingredients for doing this and the structural pieces that you need. In summary, the improved capital availability, the tech hubs that we now have across Europe, and hopefully improved policy support going forward, I think that will help founders in Europe to turn the complexity that the continent has actually into a competitive advantage.
Fantastic. I'm just going to ask you specifically about talent. When you're talking about the talent that is so rich right now in Europe, are you thinking about anything specific in terms of data scientists? Is it quite specialized? Is it particularly enabling a certain type of business one can build, or just more broadly?
Well, it's an interesting question. In the era of AI, you also got to think, who will be able to build software going forward? It's not just going to be the software engineers, but we have much more than that in Europe. We are speaking to amazing teams across different areas, especially in the deep tech space. We're seeing the first space companies being built out of Europe. We haven't seen that in decades. We're seeing teams in the areas of nuclear fusion. So don't just think in terms of technology, what are the next B2B software companies? And that, by the way, that space has also grown massively. But I think much broader across Europe, where we are also having fantastic universities that are often leaders in their specific space.
Fantastic. So, Philip, turning to you, your business has clients that range from Australia to the US to Saudi and everything in between. Having this global view, give us a sense, let's set the stage now. How does the EU market, which will be the native home market for this champion we want to build, compare to the US and China in terms of scaling large companies? What are your observations?
Yes, well, as we mentioned already, for us, it's easier to enter markets outside Europe than to enter markets inside Europe. We are pretty strong in Germany and the DACH region. We can reach to UKI because that is English international language, and maybe Benelux. But it's harder for us to expand to France, Italy, or Spain compared to the US market, for example. So that is at the early stage for sure a barrier that you can scale fast enough. We have a conversational AI, so we have a language issue with these Asian markets. But Australia is easy. We want a big client in Australia. International markets are easier to enter compared to Europe. So that is a barrier in the early stage. When you want to reach $1 trillion valuation, you need to fulfill two conditions. So first one, you need to be a global leader. We proved that in Europe with some, let's say, car manufacturers. Second, you have to be a global leader in an industry that pays such high multiples. And that is the second that we didn't achieve now. Could we do it? I'd say yes, because maybe we lack a little bit in innovation. If you look at the car manufacturers in Europe that are the global leader with the highest valuation before Tesla came, I would assume it's not that hard to make the EV shift from this global leading position. And if that, we would be maybe one of the trillion valuation companies now. But we didn't. Maybe it's a little bit compared to the US companies, maybe they're a bit more innovative than compared to European companies, because they made it and we didn't make it, although we had the global leading position.
And so are there regulatory or structural barriers? And how can European founders work within these parameters and deliver that innovation and building at scale? And how should the broader tech ecosystem work together to challenge some of these barriers?
Yes, it's correct that we have some regulatory challenges in Europe, but also in the US. We have different tax systems in the different states. So that is not easy to enter the US market. So we have different sales tax in every state and all this stuff. So I would say this is a challenge for the early stage, for the Series B or C companies. But at the end, to get a valuation from 100 billion to 1 trillion, it shouldn't be the regulatory challenges anymore. So this is for the start, yes. And maybe we need more unicorns to get a trillion. I don't know how it's called, trillion. But that is a reason at the beginning, but not from the scaling from 1 billion to a trillion.
We focused a little bit on some structural obstacles that are making that initial original move out of you gaining that original scale more difficult. Is there something also about capital markets that, Alex, you mentioned also that we have great funding now. This was one of the building blocks. You need to have the funding. You need to be able to have failures. You need to be able to give enough capital to actually go and expand for the go-to-market, right? To hire abroad, etc. How should companies approach the capital markets differently? Is there something that companies can do to make it easier, in their risk appetite and the actions they take? What should they be asking investors for in terms of capital or flexibility in order to allow this kind of growth, innovation? Which one of you? Yeah, go on.
Totally. Well, for sure, we are early stage investors. We do keep investing also in the follow-on rounds, but at some point we're also dependent on bigger investors investing higher amounts of capital into the companies. But I think when you're a founder and you have that ambition to build a truly global company, then when picking your early stage investor, and if you're a great founder, we have the ecosystem, you can pick the fund that you work with, the firm, then you should pick a firm that is aligned in that thinking, and a firm that will not think of just handing over the baton to the next fund and thinking, well, I'll make a nice 5 to 10x return, and what happens later, it doesn't matter. I think that mindset, that alignment you need on day one. So you need that across the stages, whether you're picking your seed investor, early stage investor, or your Series B investor. I think that mindset is very, very important to have aligned in every investor that you pick.
That makes sense.
And you have to pick big enough investors, because to get a trillion valuation, you need to invest long-time growth, right? Maybe one reason is that we focus too early on profitability, and maybe we try to exit the companies a little bit too early and are not willing to fuel the growth rate compared to Amazon. I mean, I don't know how many years they need to get profitable, 16 years, 20 years. This is a pretty long time that they grow and grow and grew and grew and grew. At the end, they got these big valuation because they have laid ground for that. So the growth now is the profit of tomorrow. And that is maybe what the European investors are not willing to pay in the long run. So that is another challenge.
That's a very good point. It's basically not just talent, entrepreneurial talent willing to take the risk to build businesses as opposed to just going and getting the cozy corporate job they could be getting in Europe. It's also the European investor mindset that has to be changed. Now, how do you as CFOs, what is your role in changing that? If I look at myself as an investor, sometimes we may be a bit too conservative. Sometimes we ask for the path to profitability to be so much sooner, so much faster. What can you do as CFOs to give the investors the comfort that the steps you're taking, even though you are burning capital, are systematic and well thought through, and to provide that funding for longer, like you say, even when it's not profitable in the near term?
Yes, maybe I can answer that question.
Yeah, I'd love to hear from Alex because you're in the value creation.
Age-old question about growth versus profitability. As I said, it's impossible to invest to the growth as long as possible, because The longer you grow, the higher the profitability, the profit you can earn in the long time. But what is very important during the growth phase, that you spend every dollar wisely. So the efficient of the growth is so important to have a look at, even to explain it to the investors, that you say, okay, what is the capital efficiency, cash burn multiple, and all this stuff, to have a look at it. What is the euro that you spend to your GDM, to your go-to-marketing strategy, in terms of what is the payoff and growth? So as a CFO, support in terms of where do you want to spend the money that we get from the investors to get the most value out of it, not in terms of profit, but in terms of efficient growth. Can we enter new markets? What is our learning from Cognigy? It's always good to have a strong focus on what you do. So let's say regions. 2 years ago, big internationalization strategy with MENA market, Asian Pacific, Dubai, Saudi Arabia, whole world. We say only 30% of the money that we have now. We spend the money on 2 markets, Europe and the US first, try to get a strong footprint there and expand from there, and then take another market. So focus and efficient growth. Look at the right KPIs, capital efficiency, cash burn multiple. That is what a CFO can do for sure, and get all these processes, most efficiency. So that is for sure the infrastructure. Has to be correct, but that is the daily work to have all these processes implemented correctly and all this stuff.
Right. I'll come back to those KPIs and tracking them and educating the CEO and the board. Alex, what is your view?
Philip said it very clearly. It's not about either profitability or growth. It's about efficient growth. Investors love to spend money when they know where you spend it. If you cast your mind back to, 3-4 years ago, you had companies raising tons of money, 20 million, and then they would show you 1 to 2 million ARR. Well, and maybe they grew very quickly in the beginning, but it was either sustainable or they were trying out too many things. And I think we've seen it a lot in the past, raising lots of money, trying too many things at the same time. We spoke also about international expansion, etc. I think it's about and that's where CFOs play such a critical role. You are basically the quarterback of the founders as a CFO. You need to be able to build that narrative very clearly around where is the money actually going that's being raised, and how are you using it? How are you analyzing whether a go-to-market motion works or not? How many times can you try this? I think all of that clarity is so often missing in early stage companies. That's part of the journey. Every company hires a CFO too late.
Yeah.
That's usually my summary. But it's never too late. And I think the earlier you have that capacity in the firm, maybe it's a VP finance, it doesn't always have to be called CFO, but you need that responsibility to actually track these efficiency metrics. If you can tell that story and bake that in properly into your equity story, then you're also able to attract a lot of investor money.
Yes. Now, Alex, talking about efficient, how do you measure that? Is it just a specific benchmark? And okay, if you have benchmarks that you hold on to, the question then becomes, it's a business, right? So you made a decision, or the entire business made a decision to hire account executives in Dubai, etc. How much time do you allow them until you draw the line and say it's not efficient? Because you can't measure it in 3 months. You can probably measure it in 6 months. But at some point when something goes wrong, it's always a bit too late that you react. So how do you actually also think about how much time for experimentation you should be trying this, that you give companies? And, I'd love to hear from Philip afterwards internally how you try to keep those boundaries or set those benchmarks. But when you look at companies, Alex, especially because they're earlier stage, how long do they experiment until you draw a line and say, this is not efficient growth?
Yeah, of course, we invest in the founders. So it's not us laying out the whole plan and they only execute it. We rely on their knowledge, experience, etc., to make that call. But at the same time, what we often we won't have a specific number where you say, okay, this is how much money you can spend, and then you need to try something else. But obviously, once we invest, the first meeting that will happen is, what's your road to Series A? It's the very first meeting, and you sit together and you try to give input from our side, what we think works, what doesn't, more as a framework rather than setting specific numbers. So that's one thing. And then obviously one thing that is powerful and that founders often ask us about too is we just have, we've done 135 investments overall. We track a lot of numbers. So when it comes to efficiency metrics and growth metrics, we are obviously able to compare.
Right.
Now, yes, we're an agnostic investor, but at the same time, we have a very good idea of what is best in class in growing towards 1 million, 2 million ARR, what's best in class, what's maybe not. If you grow that very quickly and we see good development on ACVs, etc., then that's evidence of whether you're hitting something interesting or not.
And Philip, what about you? Because there's always, how do you create the trust of the CEO? Because many times you have to educate the investors, but then sometimes it's also about the CEO, right? You're observing the numbers. You're starting to say, well, this is getting out of the range, right? This is not really looking so good anymore. But then, the CEOs have their vision. How do you create that trust for them to listen to you? How do you make yourself in that room visible and credible to be able to drive outcomes rather than just signal things and inform?
What is my experience, what works pretty well, is to build some small business case for every investment based on a driver-based model. I'll give you an example. We have a ramp-up period from our AEs from 7 months. So they start, and then we give them 7 months before we expect the first year that they close. Okay, so that is easy to build in the Excel model. Now we invest money in our GDM team, let's say 2 FTE, 3 FTE. And then I say, yes, but what is the reason for that? Yes, we want to reduce this ramp-up period. And so it's easy for me to calculate in the model how much we invest, let's say 500K for the team. We decrease the ramp-up period from 7 to 6 months, and then we have a ramp-up of X euro in the CRR. So this is an easy case based on a driver-based Excel model. And when there's another investment or another wish that we can build a business case out of it, then I say, yes, but what is the effect and where can we show it in the numbers and what is the cash efficiency? So we should add, let's say, at least 800K, maybe above $1 million. So we need clear to one and get better and better. And so the first question is, what is the leverage to the drivers of our model? Which driver do we affect? Even if you look at, let's say, buy a tool for software that enables us to check our contracts or support our contracts. We increase the volume that one lawyer can proceed from 2 million to 2.2 million because we have this tool. And so this is another idea to have for every euro that we want to invest. I don't talk about 10,000 euro or something, but about 100,000 euro. So let's see. And then we can discuss it with the CFO. And I always say, when my investors ask me, how can I explain them that we want to invest those money? So, and then we derive the answer together. That is always a good idea. What is the effect of the investment to the drivers of the model of our business?
Yep, that makes sense. So, obviously to build a 1 trillion company, one has to build globally, right? One has to play the global playground, right? Does one do that day one? Alex, do European startups, because of more fragmentation and structural barriers, have to think beyond borders earlier than US companies? And how do you manage multi-country operations from the beginning? What are the things you have to really spend time thinking about?
You mentioned already the smaller home market. Let's not take Germany. Let's take a smaller country in the Nordics, Sweden. Oftentimes we look in those countries, especially when it's about expansion, because these founders are forced to thinking internationally from day one. It's not a choice. It's a necessity. You don't even need to go out and raise money if you're considering otherwise. So thinking about this from day one, and even as you define your business model and in which areas you want to build a company, I think this is so important. There is no such thing as a home market advantage versus what you see in the US. We don't have that here, but it forces you to think internationally, or it should. Success will ultimately depend on mastering this cross-border complexity. Now, more specifically, and that's hard, right? At the earliest stage, you need to put not only money, but also team capacity into structuring different country operations. The effect, the implication to that later on, yes, it's costly and annoying, but it can be much more disruptive. We've seen that when consolidation doesn't work, it impacts your due diligence and fundraising, your reporting isn't clean. These things can be very dangerous. You need to think that early, and the timing is important, right? It comes also with building out the finance function not too late. You
Right.
need people to think about this early enough, and also with an idea of what to do at what stage.
Right. I would love to remind the audience that they can ask questions. So, please do in the Q&A tab, send us questions. Philip and Alex are here to answer whatever is more relevant for you. We've taken the discussion in a certain direction, but feel free to take it in any other direction.
Even in the early stage, it's very important to reserve enough money for sales and marketing. Maybe that's a difference between the European and the US market. Then our colleagues from US spend maybe a lot more money for sales and marketing in terms of role. Maybe we spend more money in product development, which is also good, but in the long run, the best product will work. But if I look at Apple, I don't know if they're best product, but they definitely have the best branding and the best marketing. So this is also, and what my experience, especially for early stage companies, that maybe they have a good product, but they have not enough money to sell it. Enter the market, we spend a lot more money for our GDM, certainly compared to the R&D section. But if you want to grow, you have to spend money in these sales and marketing organization.
Yep.
And maybe that is another challenge that we, as Europeans, stick more to the product development in terms of marketing.
Interesting. And that's a mindset, maybe to a certain degree, and a cultural thing, but obviously can change. This takes me to another question about building trillion-dollar companies. You cannot have just kind of everybody grow up with it. You actually need people who have seen, I would say, the movie play. You need to be able to bring experienced C-level executives to the table. And obviously, to a certain degree, if we don't already have one such business in Europe, then it's hard. The C-level executives are not kind of floating around, running around, and you can just hire them and then benefit from all that knowledge. So you're effectively kind of reinventing the wheel in Europe, right? So how much of a preoccupation is it at C-level to attract top-tier talent? What can we do in Europe to attract talent in our fund? There are Europeans who went to the US 20 years ago. They scaled big businesses there. And actually, we're lucky now they're for us operating partners, but they've come back from Datadog, from RingCentral, from Automation Anywhere, from Expedia. They could help and be hired. But is there a reluctance to bring outside talent, especially when it's very expensive? It's going to be expensive. What are the discussions at the board about? Is there enough awareness that one just also cannot just build with pure, throwing money at kind of the GTM, but you need like real experience C-levels?
Exactly. So talent, maybe for us, is one of the hardest challenges to face. We're happy that we can hire people from Europe, UK, US also. So we have a huge US team of 30% of our company comes from the US. They're much more expensive. But what can we do? The US government does enough to shift some talents to Europe.
Now it's helping us.
So I think we should definitely align our competencies in universities in Europe. We have to stick together and overcome these regional barriers. It's easier to hire an employee in the US compared to Spain or Italy. It's really annoying. So it's complicated.
I was really more focused on sort of the seniority of kind of an experience level. Is that the case across?
Yes, exactly. So even if you look at, let's say, so we want to hire GDM or marketing global head. And it's easier for us to find this in the US than in Europe. So
because they have the right skills that you need, or because the labor market is just more flexible, more dynamic?
Maybe all the sellers have gone to the US. So finding one who has experience to bring a company, a Series C company to $1 billion or above $1 billion valuation, it's easier to find than to find in Europe. So that is the simple truth.
What's your experience, Alex?
Like you said, it's different across stages. At the early stage, we're doing much better with much broader talent pool than we had a decade or so ago. That got much easier.
Mm-hmm.
Not everything is in London. You have more hubs than Paris doing amazing. Berlin is doing amazing. The Nordics have a fantastic ecosystem. The people that have decided to go into tech and work some years in tech, they're not going to go back to, they stay in the market and they broaden the talent. You can't compare us to the US yet because they have just decades more. To Philip's point, I can perfectly imagine that at that size of the company, you're looking for a global head of sales, for example. That's definitely going to be easier to find in the US because they are trillion-dollar companies where they have done that scale. At the early stage, I would say in Europe, we were very good already. It'll take a little bit more time, and we invest very long-term, 10 plus years. That's why I'm also confident we'll get there. Klarna IPOs. There's going to be amazing talent. Already left Klarna, they're building new things. There's going to be amazing talent out of these companies, out of Revolut, etc. Just naming a few big ones. They are not going to go back from being a head of sales at these companies into doing something in the old school corporate world. They're going to stay and look for the next company where they can see that journey again. And so it just will take time that hopefully what Phillips and his team is looking for now, that in a few years' time, it'll be easier to find it in Europe too.
Yes, and we can support these process via networks, right? And we have so many recommendations from our investors like Eurazeo. So that's really great. They come up with a monthly suggestion of potential employees. Maybe we can hire that. So and across all portfolio companies. And if every investor would do it, so actually that is a good idea to come through those talents, to get to those talents, right? So this is also maybe an idea to improve the search.
Fantastic. Now we have 8 more minutes. I don't see any open questions. I'm going to remind everybody about questions. Let's think about what excites you. So now we have the building blocks in Europe. What excites you? What kind of businesses have that potential? In what sectors, in what verticals? What do we actually build? Because it has to be something, like you said, with just product superiority, but it has to be selling on a large enough total addressable market to truly be able to get to that scale. Are we building in Europe right now those companies, that potential?
Well, the agentic space, obviously, across the border, it's really come like a wave through our deal flow, but really across so many different verticals. Of course, we always look at what's the defensibility going forward. And I think that's one key part and one challenging part to estimate at that time. And then, yes, B2B software, again, decade ago, there wasn't much around. We also, from early days, did a lot of B2C stuff. We were very successful with it too. We have great exits, fast growth. At the moment, or if I would say the last 3 years, we've done 70% in B2B SaaS because there's finally B2B SaaS solutions, and we still see a lot of those working also with AI that just serve this sleeping giant of the economy in Europe, but especially Germany. That's called the SME space. And it's about them enabling to use AI, to use better software, etc. So there, we're seeing a lot there. And I think that's just the beginning of what we've seen of unlocking this industry that's so important also for Germany, but also the rest of Europe. We're seeing super interesting stuff in more in the deep tech space, more so now than I would say a few years ago. It may have to do with the recent months and the pride that Europe has to redevelop. Maybe it has to do with that too. Again, I don't think founders time the market, and these smart people that we're currently speaking with in certain deep tech verticals, they have been obviously not at this since yesterday, but since some time. But they've been educated here. They've been working for European companies, and they are building in Europe.
Yes, software for sure. If you look at SAP, they have 300 billion now, so they get closer to the trillion. But also robotic, maybe. So this is look at combine AI and software with robotic. That is definitely a potential market for $1 trillion company. Maybe sustainability. This is not that popular anymore, but I think in the long run, maybe it's getting more popular. And for sure, AI, that is the big thing. And we give our best.
We're on the path. It's all about being on the path.
Yeah.
So maybe for kind of your peers here in the room, as they think about their own contribution, what actions could they be taking at the strategic level when conversations are happening, when it's all about setting those ambitions, those KPIs, those, the vision? What do you do, or what have you seen your peers do to push companies forward, to not plateau, and to keep having the ambition and thinking so that they get bigger? There's $1 billion on the way to $1 trillion, right? That is just like, how do we get there?
Yeah. I can say maybe it's simple sense, and then Philip can do it better because he's the CFO in a company. But I think as a CFO, you need to have the same ambition level as your CEO. It starts with that, and make it very clear how to invest in growth. So what Philip mentioned earlier, measure the stuff that you do and make it really digestible for the board level to see what is the additional capital that you're asking for, where does it go exactly, and what is the outcome of it. Make it really tangible of what you're trying to achieve with that. I think too many board meetings are the review of numbers and performance, and that's important. But equally, you should spend time on where do you invest future money, and how do you invest it, and how do you measure the efficiency going forward of how that money is used.
Yes, exactly. So I would say the CFO has to support the founders in their mission. If they have aggressive plans to build $1 trillion company, as a CFO, you shouldn't say no. You should say, okay, how can I support you to do that? And if they don't have these ambition and say $1 billion is enough for me, can you, as a CFO, convince them to build $1 trillion company? So I think, yes, you have to support their mission and say, okay, if we want to achieve that, we have to do that. We need that money, you can, all these calculations. But that is very important. And we can show as a CFO the growth potential for sure. So if we see another growth potential for the next year, then we can say it would make sense to fuel this growth and to finance it because we have this potential. And if we say, no, we cannot grow by 80%, but maybe for 30%, then we can think about, okay, what can we do? We have limited options to grow, and we can provide all the information that a founder needs and an investor. How much do we need to grow? How much money do we need to get to the $1 trillion and all this stuff? But for me, yes, it's a supportive function to the mission of the founders. But actually, you have limited influence of what is their plan at the end.
But is it, so maybe to close off on the topic of AI, when you were talking about sort of ability to grow, obviously, a lot of AI tools are improving costs, but are actually revenue generators right now. So there is a chance to really retool the organization on every single cost level, but also to really increase the revenue. Should the CFOs be some of the early proposers of adoption in the enterprise? Everybody feels behind in adoption in the enterprise, right? In terms of AI, everybody knows they have to do it, but everybody's behind. I mean, what is the role of the CFO? Maybe we can kind of close on this topic. How much should the CFO be pushing for this? Because they have the full picture.
Exactly. So I would say the CFO develops from the navigator of a company maybe to its innovator, because we have so many informations from the numbers perspective that we can give impulses and advice and recommendations to the CEO. How can we innovate the company? Focus on the revenue increase with our AI solutions. It's much better than focus on the ability to reduce costs for our clients. So this is, if you want to grow and show them here some ideas how you can improve your revenue growth for our clients, it would be much better. Also in terms of pricing, margin. So yes, be the innovator, be kind of internal consultant instead of just calculating the numbers. That is a very big part of the role of the CFO.
Fantastic. I think we're over time. We did get one question. AI uses a lot of energy, and companies are required to report on their energy and reduction of carbon footprints. How do you balance this for a very large corporate? What do you do? Because AI uses a lot of energy. But
exactly. So we try for sure the energy can be produced in a sustainable way. We try to use, let's say, providers that provide all these server capacity that we need on a sustainable basis. Cost maybe a little bit more. Most of our clients are willing to pay this premium for sustainability of higher produced energy. It's a challenge that we have to face. Every industry has to face in the AI industry. What do we do with energy costs? And that's why I say the sustainability sector industry maybe is even stronger. And if you look at the Chinese provider that need much lower energy to produce not the same, but the same outputs, that is an issue.
Yeah.
For now, clients are willing to pay a bit more premium for sustainability.
I mean, maybe what I would add to this specific question is that very large models are using a lot of energy, but actually, there are businesses, right? I mean, Cognigy is one of them that actually optimize which model you're using for the specific use case. So you are moving towards smaller models that use less energy, and that's part of it. But there's a lot of comments here about, e-waste and yeah, absolutely. I think we're out of time. Thank you, both of you. Thank you, Alex, for bringing us the 1 trillion company vision. And I love that it's called a manifesto. And thank you, Philip, for joining us and telling us what you do. Hopefully, audience took away some concrete facts from here.
Thanks very much. Bye-bye.